Hello, everyone, and welcome to Prepare to Pass series of financial management, which is now focusing on the March 19 exam. Here are my details. So my name is Waleed, and I teach financial management and the advanced version of this paper at PwC's Academy in Dubai. I have put my contact email there. So after this webinar series is over, and if you got any quick questions on things we have covered on this webinar series, I'm very happy to answer your questions there on this email address. It is really important that you have access to these links. So these links are on the slide pack, which you should have with you. The more important links for this webinar are the FMCBE past exams for today. So I would appreciate if you can please log on to this link of FMCBE past exams, because we will be covering few questions from the past exams which are within this link. So as I'm going over some of the topics and stuff, please ensure that you are logged into this page. So here is the plan. We have got 4 sessions on hand to cover everything on financial management. Today's session is focusing on investment appraisal only. And then we'll go into business finance, working capital, and then valuations and risk management on session 4. So here is the plan for today. We are focusing on investment appraisal. The plan here is that we are going to cover the key investment appraisal areas. So I'm going to do a little overview of some key topics within investment appraisal, things like NPV, payback, discounted payback, a bit of IRR maybe, and if time permits, the EAC, equivalent annual cost calculations as well. So we will see how much we can do. We've got 2.5 hours. The aim is also to get through some question practice. And if we can hit like 50 marks worth of questions for today, it would be really, really good. If I fall short of this target by a few marks, I can always set a bit of homework, and then you can do those questions later in the evening or tomorrow. So here is the questions list which I have prepared, keeping in mind the March 19 exam. So I think that these 5 questions are pretty much covering most of the areas of investment appraisal. So if you're looking for some exam-specific question practice for March 19 exam, I would say that these are the 5 good questions to focus on for this March 19 exam on investment appraisal. Now, we will be doing a bit of question 1 here, Hayback, and Pelta, question 2. And if time permits, we will go into the question 3, Millennium as well. So Hayback, Pelta, and Millennium are the questions which I'm going to focus on today. And then there are questions BIP and HCW, which are very good questions as well to do for your March 19 exam. So that's the plan. And this is what we're going to do. So let's just get down to business. Now, the rules here are that I am going to go over the topics. Wherever I feel I have the capacity to take some questions, I may ask you to write some questions. Otherwise, you can always drop your questions, and wherever I can, I will refer to these questions and try to answer them within this webinar. So let's get down to the topics for today. So we are going to look at investment appraisal. Now, the worth of investments is seen in this topic. So basically, we are seeing viability of investments. And we have got some techniques on hand through which we can see viability of the investments. And for your exam, the three most important things that you need to know will be NPV, IRR, and the payback plus the discounted payback. So these three are absolute essential. And in addition to these, we have some more areas as well here. Things like ROCE, things like EAC, things like lease and buy decisions. All those are areas that are a bit non-core, but in terms of the core investment appraisal areas, we're looking at NPV, IRR, payback, and discount payback. Now, when I use the word core and non-core, that doesn't mean that non-core areas are not important. It just means that they are slightly less examined as compared to these areas in the past. Now, let's have a look at a bit of NPV, the net present value. So if we have to explain that what is the idea of net present value, what we're simply going to say is that it is when we discount relevant free cash flows of a project to find their worth in today's time. So this is how I will explain NPV. Now, there are a few key words here which we need to talk about further. I'm sure we're okay with the idea of discounting at this point. So this is a revision webinar series. So I'm hoping that we've gone through the tuition phases of preparing for these revision webinars. And we know what discounting is. That is to find the present value from a future cash flow. Now, the other word is relevant and FCF, the free cash flow. So let's just focus on these keywords here. Now, relevant cash flow is a cash flow which is future and which is incremental. So a relevant cash flow is a future cash flow and incremental cash flow. The word incremental here means that it is a cash flow which is caused by the project. So any cash flow caused by the project is incremental. So for example, I'm doing a project and I want to rent some space. Now that rent which I'll pay for this space for this project is incremental. So we are discounting relevant cash flows, but these are the free cash flows. The free cash flows. And free cash flows are ready for discounting. The word free cash flow means that it is a cash flow ready for discounting. That means no more adjustment is required on these cash flows. So if the examining team ever use the word free cash flow, that means the things like tax, investments, working capital, scrap value, all these have been adjusted within these cash flows and they are simply ready for discounting. Please never adjust the free cash flows because they are already adjusted for everything and we only need to discount them. So we discount relevant free cash flows of a project to find their worth in today's time. Now, we can compute the free cash flows, and I always use a little mnemonic here to compute the free cash flows, and that mnemonic is Otis W. Now, Otis W is the mnemonic to calculate free cash flows, and this is operating profit. And I'm sure we know that operating profit is basically sales minus the costs. So it could be your variable relevant costs or the fixed relevant costs. So operating profit is sales minus the cost. Then we have the tax to pay. Tax to pay. Now this tax to pay could be in same year or arrears. And then we have our tax saved on depreciation. Now, depreciation itself is not a relevant cash flow. It isn't a cash flow either. So it's irrelevant depreciation. But the thing is that the tax saving on the depreciation is relevant. So the key part to understand is that although depreciation is not a relevant cash flow, but the tax saving on depreciation is relevant cash flow. So we will think about that. I is for the investment, and we mean here the initial investment. S is the scrap value or the realizable value of your assets once the project is done. And finally, W is the working capital. The working capital. So this is the memory aid here with which we can compute the free cash flows. And once we have got the free cash flow, we can then look at discounting the free cash flow to find the NPV. Please remember that free cash flow is a cash flow which does not need any more adjustments. It is just simply ready for discounting. So nothing needs to be done on these free cash flows. And we can see why is that, because all the adjustments are made here within the AutoSW. Now, the next thing here is that we need to understand a bit on the idea of working capital. Sometimes this is the working which causes a bit of confusion to the students in the exam. So I just want to think about the working capital. First of all, what is working capital? Working capital is the smaller investments we make for the operational needs of the project. So smaller investments to cover operational needs of the project. Operational needs of the project. Now, by default, working capital has three features. So working capital has three features by default. Number one, it is always invested at T0. So we invest the working capital at T0. So that T0 is an outflow. So the first investment in working capital takes place at T0, along with our initial investments in the machinery. Number two, we need incremental working capital in subsequent years. We need incremental working capital in subsequent years, which again is an outflow. And the idea here is that the examining team will tell us how this working capital is to be injected. They will give us a percentage of growth or inflation in the working capital, and then we can simply inflate that initial invested working capital to find the incremental working capital. So I will again show you this when we hit some questions. We have a good question for today where working capital is covered. So we will see how the investment takes place at T0, how the incremental working capital is invested in subsequent years, and then finally release back in last year. And this will be an inflow. So once the project has been completed and everything has been recovered, that is the receivables, we have sold the inventory and everything, all the money has been recovered. So we show the working capital investment as a release back, as an inflow in the last year. Now, these three features are by default. So investment at T0, incremental, release back in last year, they're all by default. Now, if the examining team does not want us to do any of them, then we will follow the instructions in the exam. So this is not an area where I can just rote learn anything and just do the same working each time. It depends on question to question. Sometimes the examining team doesn't want us to do the point 2. Sometimes they don't want us to do the point 3. And if that is the case, then I will just follow the instructions in the exam. So I will show you one question today, and we will see how the examining team wants us to deal with working capital there. But these are the three bigger or default features of working capital. Now, doing numbers on NPV is just not enough. We also need a bit of evaluation of NPV, because in the discursive answers in section C, we could be asked about explaining how NPV is a good method or what are its limitations. So we need to think of some advantages and disadvantages of NPV. Now, I'll be a little quick here on the advantages and disadvantages, just to give you an idea of points that you can bring out. The first advantage that we can bring out on NPV is that it is based on cash flows. It is based on cash flows. and not accounting profits. So difficult. So it is difficult. It is difficult to manipulate. So cash accounting is difficult to manipulate as compared to the accounting profits. Number 2, evaluates entire life of the project. So a decision based on NPV considers the entire life of project, just not few years. So in that sense, it is a really good measure. It's a long-term measure. Thinks of the overall life of the project. Number 3, shareholders' view is considered. Shareholders' view is considered as positive NPV directly increases shareholder wealth. So it considers the shareholders' concept view. Number 4, time value of money is considered. Time value of money is considered, making it realistic as we discount the future cash flows at a discount rate. Now, these are the 4 advantages of NPV that I have put here, and you can always remember them with a bit of a memory aid again. And the memory aid here is best. B is that it is based on cash flows. E is that it evaluates the entire life of project. S is that it considers shareholders' view. And T is that the time value of money is considered. Now, I'm sure that you know that there are lots of things in this syllabus that we need to learn, like formulas and things in the syllabus. But these memory aids should become really handy when you're doing the exam, just very quickly letting you think of these points. So best is the memory aid for advantages. Now, in terms of disadvantages of NPV, we are going to look at 4 disadvantages as well. Number 1, the projected discount rate may not be accurate, resulting in wrong NPV. And because we will be discounting the cash flows of a project, if our discount rate is not right, that means the entire NPV is not right. Are the rates like inflation and tax are assumed to be accurate, and constant within the project life. So this is, again, an assumptions you would have seen in questions where, for example, tax rate never changes. Sometimes they say inflation will be 5% on cash flows, and then that never changes. But in reality, is that possible? Well, highly unlikely. 3, it omits non-financials completely. So we never think of things like impact on stakeholders, impact on employees, etc., etc. We never think about that. It is purely a financial measure, so omits non-financials completely, which may be important for businesses. And 4 is that budgets or forecasts may not happen as predicted. Budgets and forecasts may not happen as predicted. For example, your sales and the costs. All these may change in reality in future. So the memory aid here for the disadvantages is prob. So P is that the projected discount rates may be wrong. R is that the rates such as tax, inflation, growth may be wrong or may not remain as predicted. O is it omits non-financials, and B is that the budgets of or the forecast may not be right. which means our NPV analysis will change. Now, this is it on the overview of NPV. Now, I'm open to taking any quick questions here before we directly jump into a question to practice these points and see that what is a free cash flow? How do we discount a free cash flow? What is a relevant cash flow and all these things? So if you've got any questions at this point, I'm very happy to answer them. So please feel free to put your questions now. Okay, so there's a question here that if I can go over the last disadvantages. If I can go over the last disadvantage, yes, the last disadvantage is that the budgets or forecasts may not happen as predicted. Now, things like sales, sales volume, and our costs, they're all budgets or forecasts into the future. And if these will change, that means the NPV analysis or the NPV values will change. So we are assuming here that these remain as predicted, whereas in reality, that may not be the case. Another question here, please repeat what is a free cash flow. Simply a cash flow which is ready for discounting and does not need any more adjustments on it. Okay, so as I'm taking more questions, can I ask you to please look for question here back, which is September 16 exam. Question here back, September 16 exam. So you can either get this question, which is within the documents on this webinar, which were sent to you, or you can also go into the CBE past exams, and within CBE past exams link, which I have given on my slides, the September 16 exam. So September 16 exam from CBE past exams. Okay, so past exams, there are some instructions which we need to click next. Some really important instructions in your exam, and I would advise you read these once so that you're well aware of how the exam is and what are all the options involved here. And within the CBE past exam, I then want you to go into question, I think it was 34. Question 34 on the CBE past exam called HIBAC. So question 34. So that is the first question we're going to see. HIBAC. Okay, so let's have a read of this requirement here. It says calculate the net present value of the investment project in nominal terms and comment on its financial acceptability. So new word here, nominal terms. And we know that nominal terms means that this analysis should include the impact of inflation. So there are two analyses in our syllabus. One is in nominal terms, the other is in real terms. Nominal terms means that this analysis should include the impact of inflation. And real terms would mean that any analysis should not include the impact of inflation. But we only do these when the examining team asks us to do it. So this is specifically nominal terms. So therefore, we need to do an analysis which includes the impact of inflation. And then we have to comment on the financial acceptability as well. And all this is for 12 marks. Now, let's read this question well, and then we'll do these workings together. So HIBAC is preparing to launch a new product in new market. So a new product in new market, which is outside its current business operations. So entire new venture for them. The company has undertaken market research and test marketing at $500,000. Now, interesting here, what we will do with this. The company has undertaken market research and test marketing at a cost of $500,000. So this has already been undertaken. Now, remember, the NPV analysis takes into account relevant cash flows, and relevant cash flows are future cash flows. So we never think of past cash flows which have already incurred. And this research, market research cost of 500,000 is a past cost. It is a sunk cost, and therefore it will not come within my NPV calculations. As a result of which, it expects a new product to be successful. Hayback plans to charge a lower selling price initially and then increase the selling price on the assumption that the new product will establish itself in the new market. So just a bit of information for you that how they're planning to launch this product. The forecast sales volume. So the last disadvantage I gave you was that the budgets and forecasts may not be as predicted. So here the examining team is giving me some forecasts. So the forecast sales volume, selling price, and the cost are as follows. So I can see here that it is a 4 years project. Now I have sales volume in terms of units per year for the 4 years, 200,000, 800, 900, and 400. Then I have selling price dollar terms per unit, which is changing, 15, then 18, then 22, and then 22. And then variable costs, which are constant at $9 per unit. So we have got all this information about this project in terms of volume, selling price, and variable cost. Then some really important information here. It says that selling price and the variable cost are given here in current price terms before taking account of forecast selling price inflation of 4% and variable cost inflation of 5% per year. So all these costs and selling price are given in current price terms, which means that the inflation has not been incorporated in them. And then the examining team is asking us to put the inflation of 4% on the selling price and inflation of 5% on the variable cost. And we will do that because the requirement is asking us for NPV in nominal terms. And nominal cash flows are the ones which include the inflation. Then I have incremental fixed costs. So incremental, the ones caused by the project. So these fixed costs are $500,000 in current price terms. Again, without inflation, would arise as a result of producing the new product. Fixed cost inflation of 8% per year is expected. So another inflation here, this time on fixed cost, which is 8%. So I can make it a nominal cash flow. The initial investment cost of production equipment for the new product will be 2.5 million, payable at the start of the first year of operation. Now, this is initial investment of 2.5 million, but I just want to focus on this wording here, payable at the start of the first year of operation. Now, what you need to know here is that in finance, there are two timings in a year we consider. Either a cash flow occurs at the start of the year or it occurs at the end of the year. If a cash flow occurs at the start of the year, it means it hasn't yet taken the effect of that entire year. So what we do is we say that this cash flow is basically occurring at the end of the last year. So start of this year means end of the last year. And if a cash flow is said to occur at the end of a particular year, we say that this cash flow has taken the effect of that entire year. So I'll give you an example with this. So payable at the start of the first year of operation means at the end of the previous year, which is basically T0 here. But if in this question, which is unlikely that initial investment would anyways be incurred somewhere in future, but if it said, let's say, that an investment is occurring at the end of the first year, then I would have taken the first year. But when it says that a cash flow is occurring at the start of the first year, then that means I need to take the previous closing year, and which in this case is basically T0. T0 does not have a start rent. It's just T0 as it is. But because it's the previous year, that's why we're taking T0 there. Fine. Production will cease at the end of 4 years. So production is ceasing at the end of 4 years because the new product is expected to have become obsolete due to new technology. So 4 years is the life of this product. The production equipment would have a scrap value at the end of 4 years of $125,000 in future value terms. So they have given me a future cash flow of $125,000. And again, notice the word here, end of 4 years. That means it is at the end of the fourth year. Investment on working capital of 1.5 million. Investment in working capital of 1.5 million will be required. So investment in working capital of 1.5 million will be required at the start of the first year of operation. Now I want you to go back to my writing on this working capital and think of the features of working capital. So what I said here on the working capital, well, what we said here was that there are three features. The first one is it is invested at T0. And that is what the examining team is telling me here. They're saying that 1.5 million will be required at the start of the first year of operation. And I told you when it said start of a particular year, we mean the previous year, which in this case is T0. Working capital inflation of 6% per year is expected. Now, they are giving you information here for finding the incremental working capital every year with 6% growth. And working capital will be recovered in full at the end of 4 years. So it will be released back at the end after 4 years. So it would be an inflow. So investment is an outflow. Incremental working capital is an outflow. And then recovery of the working capital is an inflow. So all three features will apply here on this question. Then finally it says HEBAC pays tax at 20% per year, with the tax liability being settled in the year in which it arises, which means we have got tax in same year. The company can claim tax allowable depreciation on 25% reducing balance basis on initial investment cost, adjusted in the final year of operation for a balancing allowance or charge. So we will also look at this depreciation information. Now, depreciation, as we know, is not a relevant cash flow, but the tax saving on depreciation is a relevant cash flow. So with this information that I've highlighted here, I'm going to work out the depreciation of each year, but then my aim here is to find the tax saving on that depreciation basically. And the examining team tells me here that the depreciation to compute is 25% on reducing balance. Reducing balance is where we apply the percentages on the net book value, and then the final year will be the balancing figure. This is a standard working on depreciation. So once you do it on this question, then you can pretty much do it on any question. HEBAC has a nominal after-tax cost, after-tax WACC of 12%. And a real after-tax WACC of 8.5%. Now, the question is, are we going to use the nominal WACC or the real WACC? Well, the question back to you is that are we doing nominal analysis or are we doing real analysis as part of the requirement? Well, we're doing nominal analysis, the ones which include inflation. So we need the nominal WACC here, which is 12%. The company uses its current WACC as the discount rate for all investment projects. So we know that that discount rate is going to be 12%, which is nominal. So nominal analysis should use nominal WACC. And if I was doing a real analysis, then I would have used the real WACC. Now, this is the scenario on our hands. Again, at this point, I'm open to taking any questions. So I'll just wait for a minute maybe for some questions here. And then we'll continue with the workings on this question. So please feel free to add your question at this point. Okay, so the question is that if I can explain the difference between real cash flows and free cash flows. Well, real cash flows are the ones which exclude inflation, and free cash flows are the one which all adjustments have been made. I think what you wanted to ask was, what is the difference between real cash flow and a nominal cash flow? because free cash flow just means adjustments have been made. So that has got nothing to do with the inflation part, really. So we can have free cash flow which is nominal. We can also have free cash flow which is real. The next question. The next question here is that when do we use the formula, which is the Fisher formula? Well, we use the Fisher formula if the examining team wants us to find the cost of capital using the Fisher formula. So if in the question the WACC has not been calculated or the information about the discount rate is not there, then the examining team will tell you that, let's say, the real rate is this much, inflation is this much, and then you can work out the nominal discount rate if needed, or the real discount rate if needed. But that is only if they ask you, which is a bit uncommon. What is T0? Well, T0 is the time now. So right now. The next question is, how do we know when to use CAPM and historical models? Well, that is a topic for session 2. So on session 2, we'll go over the cost of capital in detail. Another question is that the key to investment appraisal is to identify the relevant cash flows, right? Well, yes, for NPV, I would say, for NPV, it is important that we identify the relevant cash flows, because then we are going to discount these relevant cash flows. So good questions here. Just wait a few seconds before I jump into answering this question. Okay, so that seems pretty much it for now. I'll come back to questions later, and let's get into the fun of doing this question. So 12 marks on hand. So if you can do this question with me, or if you would just like to observe me doing this question, that's fine as well, because you can always watch these webinars again. So we are going to do this here back, and I'm doing part A here, which is to look at NPV. Now, the first thing we can always say here is that all workings are presented in dollar terms, so that each time I don't have to worry about the currency signs, etc. Now, before I go into the structure of NPV, there are some workings we need to do here. The first working here is to think about sales. The first working is to do about sales. So let's go back to the question to read information about sales. So here is all the information. We have selling price of 15, 18, 22, and 22 for the 4 years. Remember, this was uninflated. So selling price per unit. So we're going to put the years first, 0, 1, 2, 3, 4. There's no 0 here because we are doing a future cash flow of sales. So the first thing here is the selling price per unit. Now, selling price per unit given in the question is 15, 18, 22, and 22. Now, these are uninflated, so that means I need to inflate them. So inflated selling price per unit. Inflated selling price per unit. So the selling price inflation given in the question is 4% per year. So what I'm simply going to do is add the 4% inflation here. So we'll take the C8 and then into 1.04. So C8 is my selling price per unit, and then into 1.04. This will add the inflation in the first year. Now, I have to add the inflation on this selling price per unit, which is in the second year. So what I'll do is I'll take the D8 and then into 1.04, but this time to the power of 2, because I need to take into account the inflation for 2 years here at 4%. Then we'll do it for year 3, same way. So we'll take the E8 and then into 1.04 to the power of 3. So what this will do is it will take the uninflated selling price per unit, add the inflation for 4%, but this will be for 3 years, remember. And then finally, we're going to take the F8 and then into 1.04 to the power of 4. So this time I'm adding inflation here for the 4 years. And this has given me all my inflated selling price per unit. Do not worry too much about the roundings at this point. I will show you at the end how to do the rounding of these numbers or what you can do further to format the numbers. But at this point, just leave them as they are. So we've got the selling price per unit given in the question, uninflated. We added the inflation. So 4% in the first year. Then we took the year 2, D8 into 1.04 to the power of 2, because 2 years worth of inflation needs to take on this selling price now. And then to the power of 3, and then to the power of 4. Once we've got the inflated selling price, then we look at the volume. The volume given in the question is 200,000, then 800,000, then 900,000, and then 400,000. And then finally, we'll get here our total sales. And the total sales here are going to be the C9 into the C10. So C9 into the C10. And I can just drag this forward and it will fill up all my cells. And the final thing I can do here is I can just use this and that's it. So I have just formatted my numbers slightly just to make them more presentable and easier to read for the examining team. And that is it. This is my sales working here, which in this exam was worth 2 marks. So 2 marks on the sales working. So any questions on the sales working before we progress to the next part? So any quick questions on sales working? Could we multiply by 1.08 for year 2 sales working? No, you can't, because the inflation is 4%. So it's a presentation of these answers which is really important, so that it makes it easier for the examining team to give you marks. So please use the structure how I'm doing these workings so that you can easily get the marks, and it's easier for examining team to see these workings as they are. So please use the structure which I am showing you here to solve these questions. So I'll come back to questions in some time. Working 2 now, and working 2 is the idea of variable costs. So we have to do the variable cost working. Again, 4 years, I have data there. Variable cost is constant. Well, to be quicker in the exam, what I can do is I can just copy this, paste it here, and then just change things within it. So what I will say here is, well, here I've got my variable cost per unit, which is 9 each year, 9, 9, 9. And then my inflated variable cost per unit. So inflated variable cost per unit. I need to look at the inflation now, which is 5% inflation per year. So I will need to add the 5%. I'll need to change this one as well. Now what you can do is you can either change here 1.05 to the power of 2, 1.05 to the power of 3, 1.05 to the power of 4, or there's another way of doing this, and that way is that you can take the C17, and simply increase it by a further 5%. So I'm just showing you all possible ways in which this can be done. So take the C17 into 1.05, and then take the D17 and then into 1.05. So D17 into 1.05. And then you can take the E17 into 1.05. So I don't have any problem if you'd like to do the first way or the second way, but the thing is that we should get an inflated variable cost per unit, which I have got here in my structure. And then we got the volume and the total variable cost. So it just took me hardly a minute to do this working, but instead of doing all that again, we can simply copy the sales working and then just change things within that. So we've got the variable cost now as well. and the variable cost on this exam was 1 mark. So I have already secured 3 out of the 12 marks on this question. Any questions up to this point before we continue? So can you just send me some more questions? Well, the question here is that if there was no inflation then, well, if there was no inflation, then just ignore it. We can't assume an inflation, so we'll just ignore it there. Why inflate year one selling price? Well, because, why inflate year one selling price? Well, because the selling price was given in current price terms, and that means no inflation has been added, and we are doing nominal analysis, which requires us to add inflation on all these years, and therefore we are adding the inflation there. Then there is another question, which is, can we refer to the years, for example, to the power of year, etc., in the formula like in normal Excel? Yes, you can do, and that's what I've done here. So in my previous working, I have used the to the power of 2, to the power of 3, to the power of 4. So whether you use this way or you use this way, I'm okay with both. So we got the sales 2 marks, variable cost 1 mark, and now we're going to go into the working 3. And the working 3 here is fixed costs. Working 3 is fixed costs. So what we've got here is our fixed costs given in total terms, and these were given as 500,000 per year. But the thing is that these are uninflated. So what we need here is we need inflated variable cost, inflated fixed cost, sorry. The inflation on the fixed cost is 8% per year. So let's add the 8% inflation. So we'll take the C23, and we will take the inflation, which is 1.08. Then I can simply take the last year's figure, which is C24, and then add 1.08 on it again. I'll take the D24 and then take 1.08, and then I'll take the E24 and take 1.08 on it as well. So I've got my fixed cost now. My fixed cost, the inflated fixed cost, is here for the 4 years. And I'm just going to look at the presentation of this to ensure that I've put the separators in so it's easier to read for the examining team. And I've got another mark here. So I've got 4 marks so far for these 3 workings. So 4 marks on these 3 workings. Any final questions here before we move into the other things? Any more questions here? So we've got 4 marks at this point. Well, the question now is that what if there was general inflation? Can we inflate the net cash inflows directly? Well, if, for example, there is just one set of inflation given, then of course you need to apply that inflation to the cash flows. But if the examining team has given you specific inflation rate, like in this question on sales and the cost, then you need to use these specific inflation rates only. The general inflation rate can be used when no other inflation rates are given. The next question is, if we do not show working and solve using formula, can we get full marks? Well, you can get marks, but I will need to show the working because I don't know what you mean by full working. That is why I will suggest that please, if you can use the structure which I'm showing you here, because this structure will make it easier for the examining team to see your answers, mark it, and then give you all the credit and for you to gain all those marks. The problem with shortcut ways here or there is that you can make mistakes in the exam and you won't be showing all the workings in a way that you can get some credit. So for example, if I make an error on my variable cost somewhere, the examining team knows that I've got the other things right. so they can give me some own figure rule marks here. But if, for example, I do them in a single cell and then I make an error there, well, there is no OFR really there. So I would suggest that you use the structure which I'm showing here. Okay, so more questions later. There's a quick question. Can we solve the values in thousands? Well, yes, you can. You can solve in thousands. You can show in millions. That's up to you. I just like showing the numbers in full because I have seen students where they start working in thousands, then they switch to millions, then they switch to full numbers, and then that creates a mini mess on an answer. So stick to one way. If you want to work in full numbers, work in full numbers. If you want to work in thousands, then just work in thousands. So I'll come back to questions later. What we've got now is the next working we can do. And the next working here is the tax saved on depreciation working. So working 4, tax saved on depreciation. Now, again, I'm going to show you a really quick and easy way to do this working. There is a long way as well. And within the long way, you have to find the net book value each year, then find the depreciation each year, and then find the tax saving each year. But there is a quicker way in which we can do the same thing again. So let's look at the quicker way. But before that, let's just read this information again. HIBAC pays tax of 20% per year. That means any tax saving that they incur will also be 20%. With the tax liability being settled in the year in which it arises. So there's no time delay, same year. The company can claim depreciation 25% reducing balance on the initial investment cost, adjusted in the final year of operation for a balancing allowance or charge. Well, this is like a standard information. The only thing which can change in the exam usually on this kind of information is they can give you a different tax rate. They can give you a different depreciation percentage. They can say that the tax is in arrears. But apart from that, the structure will remain the same. So the first thing I have to do now is identify the years in which the tax saving will be happening. The tax saving here is in the same year. So I'll put here 1, 2, 3, 4. And I know that the last year will always be the balancing figure. Now, what I want you to do here is I want you to do this calculation with me. I want you to take the initial investment. The initial investment in this project, in the machinery, was 2.5 million. So we'll take the 2.5 million here, the initial investment, and we are going to deduct the scrap value from it. So I can see here the scrap value of this machinery is 125,000. So I took the 2.5 million and I deducted the scrap value from it. Now, can anyone here tell me that if I press enter at this point, what is this value showing? What have we calculated here if I take the initial investment and remove the scrap value from it? So what have we computed here? So I'll just wait for a few answers. What have we computed here? Initial investment minus the scrap value. Yes, well, that's fine. I know the number, I know the calculation. What I'm asking is, what is the value showing? Yes, brilliant. Thank you. Thank you for all the answers. You're all right. This is the total depreciation. This is the total depreciation. Yeah, this is the total depreciation. And once I will have the total depreciation here, once I will get the total depreciation here, what I can then do is I can multiply this with the tax rate of 20%. So what I've got now is the total tax saving on the total depreciation. So I've got the total tax saving on the total depreciation, which is $475,000. Total tax saving on total depreciation. We don't need to write this in the exam, it's just for your reference. So total tax saving on total depreciation. Now, what I need to do is I need to split this $475,000 in the above years. And I know that the fourth year is balancing, so that should not be the biggest problem for me. I need to start from here. Remember here it says 25% reducing balance basis on the initial investment cost. So what is the initial investment cost? Well, the initial investment cost is 2.5 million. So 2.5 million is the initial investment cost. And then I'm going to apply the 25% depreciation, and the tax rate is 20%. So I've got here initial investment, depreciation rate of 25%, and then the tax saving on that of 20%. So this will give me the year one tax saved on depreciation, which comes out to be 125,000. Now, in the long way, I would have to find the net book value each year, then find depreciation, then find tax saving. But that wastes a lot of time. So I've got a really quick way of filling in the remaining cells here. So what we can do is we can simply take the $125,000 and say, well, this is the B28, and take the 75% of it. Now, this 75% here is showing that I have deducted the 25% depreciation based on net book value terms. So take the 75% of it, and this gives me an answer here. Then I'll again take the B29 and take the 75% of it. So in a way, I am applying the concept of calculating depreciation and net book value, where I'm deducting the 25%. And because I have already adjusted the tax in the first year, I don't need to do that every year now. So we take the B29 and then simply take 75% of that. And this has given me the tax saving on depreciation on the third year. And the last year is balancing figure, which means I'll take the 475 and deduct these three from it. Take the 475 and deduct these three from it. So let's do that. Let's take the B32 and remove the B28, the B29, and the B30. And this has given me now the balancing figure. And this is done. So I have done my tax saving on depreciation working, which is these numbers. So the numbers right now here, these will go eventually into my format. And this working here on this question was worth 2 marks. So 2 marks for this tax saved on depreciation working. So let's just quickly go over this again, the quick way. The first thing is you have to identify the years in which the tax saving will occur. Then take the investment, deduct the scrap value, take the tax rate, and this gives us the total tax saving on total depreciation. Then I have to split this 475 in all the above years, and I know that fourth year is going to be the balancing figure. We start from here, we take the investment, then into the depreciation rate, and then into the tax rate. Now remember here, I've adjusted the tax once, the tax saving. I don't need to do that on each of the years now. Then we can take the last calculated figure, which was B28, and simply take 75% of it. Then take the B29, take 75% of it, and then in the last year, take that 475 and then remove the B28, B29, B30 from it to get the balancing figure. Now, if you would like to do this working using the long way, in which you find the net book value, then the depreciation, then the tax saving, I don't have any problem with that. We'll get the same answers again. But there is no point of wasting the time in the exam when there are quicker ways to do certain workings. So again, this is how I would do this in the exam, and I would encourage you that you follow this just to save a bit of time on this paper. There were 2 marks available for this working. 2 marks available for this working. Some questions here. So let's take questions. The question is, if the depreciation rate was 30%, you would use 70% to find the tax savings? Well, yes. If the depreciation rate was 30%, then in this working, I would have done investment, 30%, 20%. And then the next year, I would have taken B28 into 70%, B29 into 70%. Well, yes, you're right in that. That is exactly how I would have done that. Yeah. Any more questions? The next question is, what if there is straight line method used then? Well, if it's straight line method, then it's simply investment minus the scrap value over the number of years. And that's it. So investment minus the scrap value over the number of years. That would give you the depreciation of each year. And then on that depreciation, you calculate the tax rate or the tax saving. Why are we multiplying by 75% for years 2 and 3? Because we are doing a net book value method, and this is a quicker way in which we can adjust the depreciation net book value and then find the tax rate on that. But if you are used to doing it long way, feel free to do so, but practice it a few times, and I'm sure you do it a few times, you will really like this method because it just takes no time really to get it done. So we'll practice this again on some other question today. So you'll get one more chance. So far, I have now secured 6 marks out of 12. I've secured 6 marks out of 12, 2 marks for the sales, 1 mark for the variable cost, 1 mark for the fixed cost, and then 2 marks for the tax saving on depreciation. The next thing is working capital. So let's just finish that as well. Working capital. There's another question I saw just now, which said that should we do the format first or should we do the workings? Well, we should do the workings first because the examining team is looking to give you marks on these workings. And then we'll take the numbers from these workings into our format. So working capital, 0, 1, 2, 3, 4. Let's look at this. Okay, now let's read the working capital part again and then come to this working. Investment in working capital is 1.5 million required at the start of the first year of operation. So let's think of that. So here is my 1.5 million invested at T0, which is the start of the first year of operation. Working capital inflation of 6% per year is expected. So let's add the 6% now. So we'll take the B37, add the 6% onto it. Then we'll take the C37, add the 6% onto it. And then finally, we'll take the D37 and add the 6% onto it. And that's it. You stop here at year 3. Stop here at year 3. So this is my investment. And then I have added the 6% growth in the working capital to arrive at year 3 working capital. This basically is my cumulative working capital, or the total working capital that is required on this project. The total working capital required is 178,654. Now what we need to do is we need to find here the incremental working capital. Incremental working capital. So remember that the first investment at T0 is an outflow. So we'll say minus B37 to show this as a negative, as an outflow. So minus B37. Then what I need to do now is I need to find the differential between this 150 and the 159. I need to find the differentials here. Differentials here. Now what you can do here is this. You can say equal minus. Remember, it would be an investment. Take the bigger number, which is the C37, and remove the smaller number from it, which is the B37. And that will give you the incremental investment. Then, same thing, I need to find the differentials between 159 and 168,5400. So I'll say minus. I'll take the bigger number, which is the D37, and minus the C37. Then, same thing here, we'll say minus the E37 minus the D37. And that's it. This is my incremental investment in working capital now. And once we've got our incremental investment in working capital done, then the last year, remember, is the release back, which is an inflow. And what would you do here is you will simply say, well, I'm going to release back an inflow, which will be the same as the E37. The 178,654, E37. Now, if you would like to verify if you have done the right working capital working, then just take a sum of all these. And once you take the sum of all these, that should come out to be 178,654. So if you take a sum of these, it is 178,654. But we have to show that as an inflow. So that's why I just simply took this one rather than recalculating it and working out with the working with the changing signs. So I just took this directly, 178,654. But if you want to verify this number, take a sum of all these four, and it should come out to be 178,654. And I can then take these values, because these will go in the format, and use a separator on these, and that is it. This is another 2 marks here. So currently we're standing at 8 marks out of 12. 8 out of 12. So any questions up to this point? We're done with all our workings. We're done with all our workings, and we just need to think of the structure now. So I'll take a few questions, and then we'll go into the structure. So the questions are coming in. The questions are coming in. The question here is, can you please explain again the sales working? Well, I can do it quickly, but the thing is that you can watch these webinars again as well, so it would be easier for you to go over again. But I'll just quickly go through that. Selling price per unit was given, which was uninflated. We inflated the selling price using the inflation given in the question, which was 4%. So adding the 4% inflation, took the volume in, and then simply multiply the inflated selling price per unit with the volume to arrive at the total sales. More questions? There are more questions. The next question here is, please show the formula in incremental working capital. Well, there's no formula really as such. It's just finding that that outflow. So we take the minus, then in brackets, the differential between C37 and B37. To find the incremental here, we take minus D37, C37, minus, then in brackets, E37, D37. So this is how the examining team is expecting to see your answers. This is how they expect to see your answers on your in the exam. So we've got 8 marks here. We are done with all the workings, and now let's take all these workings into the structure. Let's take all these workings into the structure. So we're going to do the NPV calculation now in the structure. Take the years first, 0, 1, 2, 3, 4. The tax was in same year, so I don't need the column 5. The first thing is, I want you to now go back to my memory aid of finding the free cash flows, which was Otis W. So O is the operating profit. So the first thing is I have to work out the operating profit here. So let's work out the operating profit. Operating profit. Now within the operating profit, we know that is sales minus costs. So let me go back to my workings. So what were our sales here? Our sales were for the first year here in C11. C11. What were our costs? Our costs were variable costs, which were here in C19. And our fixed costs, which were in C24. So C11 minus C19 minus C24. C11 being sales, C19 being variable cost, and C24 being fixed cost. Let's bring them here. C11 minus C19 minus C24. And that has given me the operating profit of the first year. This is the operating profit of the first year. So let's just see this again. What have we done now? We've taken the sales of the first year in C19, sales of the first year, C11, minus the variable cost of the first year, which are C19, and then the fixed cost of the first year, C24. So C11 minus C19 minus C24 gives me operating profit of the first year. Now there's no need to fill in the remaining cells as just like this. What I can do is I can just drag this forward. Drag this forward and it will fill in all the values for the remaining years. And now I've got my operating profit here. And I can just show it as using the separators. This is my operating profit for the 4 years. No additional marks here because marks would have been computed on the workings already. The next thing on the memory aid is the tax paid. Tax paid. Now the tax rate in this question was 20%. So the tax at 20%. Tax at 20%. In same years. So equal minus, because it is a tax to be paid, C42 into 20%. So minus C42, which is the operating profit of year one, and then into 20%. C42 into 20%. Once you do this, you got your tax for the first year. And then you can just drag this forward again. No need to fill in the remaining parts. And this will automatically fill in the values. And then use the separator. And then that's it. I've got my tax for all these years. Now there's one mark here for working out the tax. So we are now at 9 out of 12. 9 out of 12 tax. Tax at 20%. Then my tax saved on depreciation. Tax saved on depreciation, we've already done that. So what I'll do is I'll go back to my workings and take these from the workings, these cells, the B28, B29, B30, and B31. Let's bring that here. B28, B29, B30, and B31. So just referring back to the tax saving on depreciation working and bringing in all my numbers from there. So B28, B29, B30, B31. And these were here, B28, 29, 30, 31 in all these years. Once we got the tax saved, then it is investment. The initial investment, which we know in this question was 2.5 million. So 2.5 million, the investment. The final thing here is the scrap value before the working capital. So put the scrap value in. The scrap value in the scenario was given as 125,000 in future value terms at the end of year 4. So let's take that, 125,000. And the final thing is the working capital, which we've done above. Now within the working capital, I need to bring these incremental working capital line, the one I've just chosen now. This incremental working capital line needs to come here in my format. So I'll just refer above and say this is B38, this is C38, D38, E38, and then F38. Done. So got my working capital line as well. And this means I have now computed my free cash flow. So OTTISW. Nothing is left here. OTSW gives us the free cash flow. And the free cash flow here is the sum from B42 to B47. B42 to B47. And I will now drag this forward, and then this will fill up all my free cash flows line here. So all my free cash flows are now here. All the free cash flows are now here. And we would have got half a mark for putting the investment, half a mark for putting the scrap value as well. So right now, 10 out of 12 marks. So this is our free cash flow. Free cash flow, which is ready for discounting and on which all adjustments have taken place. So any questions up to this point, I'm ready to take on the free cash flows. The question here is it okay to use abbreviations in the exam? Well, abbreviations like FCF or WC, working capital, they're all okay. The examining team knows what do they mean, but don't use too many abbreviations on the discussion bits. There must be some common abbreviations. So the ones which I'm using on this webinar are the ones which are perfectly okay to use in the exam. The next question. The next question is, in the exam, can we click on a cell to include it in the formula, or do we have to manually type it in a cell? Because you can't do it in, do you mean that the use of things like auto sum? Well, you can't use auto sum in the exam, so you will have to put here the formula of sum, which is equal to sum, and then in the brackets specify what you want to take a sum of. The next question is, what if the tax liability is being settled in advance? What would that mean? There are only two things in this syllabus for us. Either the tax is paid in same year or the tax is paid in arrears. I've never seen a question in this exam where tax would be paid before we incur the operating profit. So maybe there's a bit of misunderstanding there. The next question is, don't we deduct depreciation for purpose of tax and add back depreciation once tax is computed? Well, what you are referring here is basically one line of tax working. So that is another way in which NPV can be done, where you deduct depreciation pre-tax, calculate the tax, and then add back depreciation. I don't have any problem with that as well. It's just a different way of presenting the NPV. So what I'm showing here is what usually people see in their approved materials, which is a way of working out the tax savings on depreciation. But I don't have any problem with the other way as well. Please tell again operating profit. I'll show you that again. Is the drag formula function available in the exam? Yes, it is, and we are doing this question on the CBE past exams platform of ACCA. So this is exactly how I want you to do it in the exam as well. Where is the test marketing cost? Well, the test marketing cost was sunk cost, and sunk cost never comes in our NPV calculation. So let's just do the operating profit line and then close this NPV. Operating profit is sales of year one minus variable cost of year one and fixed cost of year one. So here is sales of year one, here is variable cost of year one, and here is the fixed cost of year one. So that is C11, C19, C24. So C11, C19, C24, that gives us operating profit, and then you just drag this forward to fill in the remaining parts of the this operating profit line. Okay, fine. I will come back to the questions later, but let's just close this free cash flow now. Now, there are two ways to find this NPV. The first way is that now we put the discount factors at a given discount rate in this question. The given discount rate is the nominal WACC of 12%. And when we put the discount factors, then we multiply the free cash flows with those discount factors, find the present values, and then find the NPV. So I will show you both ways. This one is for the discount factors at 12%. So 12%, this would be 1. And then we need to see the 12% discount rates. So the formula sheet is here. So 12% discount rates, 12% discount factor. So 0.893. So you got 0.893, 0.893. Then we've got 0.797. We've got 0.712. And we've got 0.636. So we've got the discount factors at 12%. And once we've got the discount factors, we'll find the present value. And we'll say, well, B49 into B50. B49, B50, which is free cash flow into the discount factor. And then we'll drag this forward again to fill up the present values. And once we've got all these present values, we'll use a separator and then take a sum of these present values, which will be our NPV. So that is the sum from the B51 to the F51. So B51 to F51. And that gives us the NPV here, which comes out to be 11,984. So 11,984 is our NPV here, which we have got by discounting the free cash flows at 12%, finding the present values, and then taking the sum of these present values. Now, this is one way of finding the NPV. You can also use another way where you do not need to put the discount factors, you do not need to find the present values, and you do not need to add these present values. Well, that is using a little NPV function in this spreadsheet. Let me show you the NPV function, those who have not seen this before. So we'll say equal to NPV. Put the discount rate in this bracket. The discount rate here is 12%. 12%. Then specify the range of free cash flows from year 1 to 4. So free cash flows of year 1 to 4 are the C49 to F49. So C49 to F49. These are the free cash flows from year 1 to 4. And then add the investment separately, which is in B49. Now, what this function is doing here is, it is discounting the free cash flows of year 1 to 4 at 12%, and then taking the investment separately because investment is already in present value terms. So NPV, 12%, comma, C49 to F49, close the bracket, and then plus the B49. These are all the free cash flows. And once we've done this, we'll get an NPV here, which comes out to be 11,980. Now, the only difference here is a bit of rounding difference, which is perfectly okay in a section C type question in the exam. So whether you want to put the free cash flows and then put the discount factors, find present value NPV, this is one way of doing it. And the other way of doing it is that I do not need all this. I simply need my free cash flows, and directly from the free cash flows, I'll use the function of NPV, which is NPV bracket 12%, C49 to F49, close the bracket, plus B49 being the investment separately. Now, I leave this choice on to you, whether you would like to use this way, which requires you to do all this, or you would like to use this way, where you just need a free cash flow and then directly the function. So that choice is on to you. The examining team is okay with both, but please don't do both. Just do one or the other. Why waste time? Why waste time? So just do one or the other. And then finally, my comment here is that the NPV is positive. Shareholders' wealth will rise. Therefore, we will accept the project. Therefore, we'll accept the project. Please write this comment in the same way as I've done. Simply saying accept the project is not enough. We have to say NPV is positive, which means shareholders' wealth will rise. Therefore, we will accept the project. And this is where we've now got our 12 total marks on this question. So I'm happy to take any questions at this point. I'll just go over the marks again on this. There were 2 marks for sales. There was 1 mark for variable cost, 1 mark for fixed cost, 2 marks for tax saving and depreciation. That means we've got here 6 marks up to this point. 2 marks for working capital, that means 8. There was a mark for tax, that means 9. Half a mark for investment, half a mark for scrap value, that makes it 10. And then finally, there was 1 mark for working out NPV. Either you do it this way or you do it this way. And then you put a comment for 1 mark, and that completes your 12 marks on this question. Any questions if you have right now for me? And just for my little research here, those of you who have seen this NPV function for the first time, can you please comment in the questions tab and tell me that I've seen it for the first time? Can you just let me know that if you've seen this for the first time, the NPV function? Okay. All right, quite many of you. All right, thanks a lot for all the comments. Quite many of you have seen the NPV function for the first time. So this is perfectly allowed by the examining team. Perfectly allowed by the examining team. Well, that's fine. That's fine. Yes. So perfectly allowed by the examining team. So please remember, either you do it this, free cash flows, discount factor, PV, add the PVs, get the NPV. This is the traditional way, which everyone knows. But few people would now know that we can use the NPV function as well in the exam, where we can take the free cash flows and directly from there, we can use this NPV function. Feel free to use this in your different questions. A small difference here is just a rounding difference. In fact, this NPV function is giving a much more accurate NPV. It's giving a much more accurate NPV here. Now, if this NPV was negative, we would have said NPV is negative, shareholders' wealth will fall, therefore reject the project. Final questions here before we move into something else. Um, the question here is why we add inflation on the previous year variable cost, because each year variable cost was $9. So inflated variable cost should be 9.45 each year. Well, it shouldn't be 9.45 each year because the variable cost inflation of 5% is being applied per year. So every year it's being applied 5%. And that's what it said in the question as well. It said it is 5% per year. So you have to increase that by 5% every year. Okay. Any more questions before we move into other things? Can we use IRR function? Yes, you can use IRR function as well. So if there's a question, I'll show you the IRR function as well. You can use that as well. The next question is why we are adding inflation taking power, because that is how you do it. So it's basically once you compound anything, you take the cash flow into 1 plus the inflation rate to the power of the year in which you want to reach using the compounded value. Uh, The next question is then why we add inflation on sales each year rather than on previous years, because the selling price was not constant in the first year, it was always changing. If the selling price was constant in all the years, I would have done the same thing which I did with the variable cost. But because the selling price was changing every year, that means I can't take the previous year's selling price and add inflation. I need the new selling price to add the inflation on it. Okay, any questions on business, finance, or WAC? We'll discuss that on session 2. This is purely on NPV investment results, so let's just focus here only. Okay, good. So we've had good 1 hour and 30 minutes. What I'm going to do here is I'm just going to stop here for a few more minutes. So this is like a little break for maybe 3 to 4 minutes. So I'll stop for 3 to 4 minutes. But within these 3 to 4 minutes, if you've got any more questions, please feel free to send these questions here so you can get your queries answered right now. So I'll wait for 3 to 4 minutes. Send me more questions. Once I come back, I will answer these questions, and then we will move into the next area for this evening. So just 3 to 4 minutes. Okay, so we're back. Good question. The question says, can we have a quick look at disadvantages of NPV? Yes, we can have a quick look at disadvantages of NPV and then move from there. So we've got disadvantages. Number one, projected discount rate may not be accurate, resulting in wrong NPV. Now, if this discount rate in this question we did was not 12% and something else, and it wasn't accurate, that means our entire NPV would be wrong. That's a disadvantage of NPV. The rates such as inflation and tax are assumed to be accurate and constant within the project life, which may not be true in reality. It omits non-financials completely, so therefore it's purely a financial analysis, which for some industries or businesses may not be giving the complete picture. Okay. So for example, if you're thinking of a non-profit organization, in a non-profit organization, it is not only the financials that we think about. Finally, budgets or forecasts may not happen as predicted, and we saw in this question there were lots of forecasts, and what if they do not happen? That means the NPV will be impacted. The next question is it a must to use the formula? No, it is not must. You are free, as I said quite many times, to use either the way of discounting the free cash flows, finding the PVs and then NPV. There's no problem. Examining team is happy with that. If you want to use the formula and save time, the examining team is happy with that as well. This question covers maximum NPV possible question. It's a good question. It's a good question. But what I will suggest to you is that you also go through the questions here on this questions list. What I will also suggest is that you go through the questions on this question list. Pelta question. These are the questions which I think are really, really good for your exam to practice on March 19 exam. So feel free to do these questions and focus on them. The next question which we are going to have a look at is the Pelta question, which is from September-December 17 exam. So I want you to go into that question, the September-December 17 exam. September-December 17 exam, Pelta. So let's go to the CBE exams. September-December 17 sample questions, and we're going to have a look at Pelta. Then a few more questions. Can we get these notes written by you? Well, I will ask ACCA if that is possible, if I can send my PDF to you. I'm very happy to share that with you if I can, and if the technology permits. I'm very happy to share these with you, the ones that I've written. So we are into September-December 17 exam now, and we are going to have a look at a recent, it's kind of a recent, it's just a few years back, question Pelta. So if we can start this. So the question was, I think, on 4. Yeah, this is a question, Pelta. So because NPV is still fresh in our minds, I think we can have a look at another quick NPV. And this time I'll be a bit quicker on my workings because we have just done a very detailed NPV. So calculate the NPV of the planned investment project for 9 marks. So after this NPV, we'll go into discounted payback later. So let's look at the NPV for 9 marks. Please note here that the examining team is not asking me to comment on this NPV. So no comment is needed, just a calculation of NPV of the planned investment project. Let's read the scenario. Directors of Pelta are considering a planned investment project costing $25 million. So $25 million payable at the start of the first year of operation. We've seen this. This is initial investment, which I need at T0. The following information relates to the investment project. I have sales volume for the 4 years. I have selling price, which is $30 constant for the 4 years. And then I have variable cost per unit, which is different in all the years. So again, there will be two different treatments of inflation that I will show you here. And then I've got fixed costs per year, which are in total terms dollar per year. This information needs adjusting to take account of selling price inflation of 4% and variable cost inflation of 3%. So I will need to adjust the selling price by 4%, variable cost by 3%. The fixed costs, which are incremental and related to the investment, are in nominal terms. So that means I do not need to inflate the fixed costs. They are already in nominal terms. They are inflated. The year 4 sales volume is expected to continue for the foreseeable future. So they expect the sales volume after 4 years. So if you were thinking in the bigger scheme of things, then after 4 years, they expect this to continue. So they're saying that this may not be a time-bound project. We are going to do our NPV based on the available information, but in a long-term view of the project, they are expecting that to continue forever. We'll see that later, why this information was given, by the way. Pelta pays tax at 30% 1 year in arrears. So a different tax treatment now, different tax rate. The company can claim depreciation 25%, reducing balance. Again, reducing balance, again 25%. The views of the directors of Pelta are that all investment projects must be evaluated over 4 years of operations, and that's why we'll do a 4 years NPV with an assumed terminal value at the end of the 4th year of 5% of initial investment cost. So the scrap value is going to be 5% of the initial investment cost. Both NPV and discounted payback must be used. Okay, so we have to use both methods, but in part A1, we're just using NPV. With a maximum discounted payback period of 2 years, we'll see this later in the next part, the real after-tax cost of capital is 7%, and the nominal after-tax cost of capital is 12%. Now, again, the question is, should we use real, should we use nominal? Well, we'll use nominal because the examining team asked us to inflate the information. And if I'm using the inflated information, which is a nominal information, then I need the nominal discount rate, which is 12% again. So this is the scenario. Let's get down to the workings, and we are going to have a look at NPV in A1. We're doing NPV, and all workings are presented in dollars. Working 1, sales, 4 years, 1, 2, 3, 4. We have the selling price per unit, which is given as 30. So I'll take that 30 here, selling price per unit, but this is uninflated. So we need inflated selling price per unit, and the inflation on selling price is 4%. So we'll take the B7 into 1.04. 4% inflation. And because the selling price is constant for 4 years, what I can do is I can take the last year's inflated selling price, which is B8, and simply add the 4% again on this. Then I'll take this one, the C8, and then 1.04 on it again. And then I'll take the D8 and then 1.04 on it again. So here is my inflated selling price per unit. So inflated selling price per unit is coming out to be these figures here. Okay. So this is one way of dealing with this, where I applied inflation here. Then I just added the inflation on the previous figures. Now, if you're not happy with this way, then the other way is this. Then the other way is this, where you'll have to say B7 into 1.04 to the power of 1. Then C7, 1.04 to the power of 2. Then D7 into 1.04 to the power of 3. And then E7 into 1.04 to the power of 4. Now, there isn't any difference really in the numbers here. We get the same answers again. So be flexible in your workings. If you like this way, use it. If you like this way, where you use the year numbers for inflation, use that as well. So I really hope that now inflation should be clear. So are there any more questions still on inflation while I'm here? So if there are any more questions, I'm happy to talk about them. The question is, could we do this NPV without inflating? Well, you cannot do without inflating because the examining team is saying here this information needs adjusting for inflation. So we have to follow the instructions in the scenario. So if that information wasn't there, then yes, feel free to do it. But if the examining team wants you to do it, then you have to do it. Okay, so I hope that is now clear. Let's take the volume. The volume is 520,000, 624,000, 71,000, and 788,000. And we'll get the total sales now. The total sales, and that is going to be simply my inflated selling price per unit, which is in B8, into the volume, which is in B9. So B8, B9, drag this forward. That's it. Use a separator. Here is my sales for the 4 years. So sales for the 4 years on this question. And there was 1 mark for having this sales for the 4 years. Once I've got the sales, I'll just copy this, paste it here, and then change the things in this working to make it working 2, which is variable cost. Variable cost. The uninflated variable cost per unit is given in the question as 10. So variable cost per unit, we got 10 in all the years. Oh no, it's not 10. It's 10.2 here. Then it is 10.61 here. And then it is 10.93 here, which means the variable cost is changing every year. Which means I have to think of adding the inflation on these variable costs, but taking the year number into account now. So inflated variable cost per unit, the inflation on variable cost is 3%. So what I'll do is I'll take the B14 into 1.03 to the power of 1. Then I will say C14 into 1.03 to the power of 2. Then D14 into 1.03 to the power of 3. And then E14 into 1.03 to the power of 4. And the reason we are doing it this way now is because I can see that the variable cost per unit is different for different years. So we have to use this way in which we add the inflation. And then the volume remains the same. And I've now got my total variable cost here, which comes out to be the values which are here. So total variable cost. And this will give me 2 marks here. This working was worth 2 marks because of the fact that inflation had to be done a little differently here because the variable cost was different. So any question on sales and variable cost before we move on? Any quick questions on sales and variable cost before we move on? Okay, seems all okay. Next thing is working 3, which is the tax saved on depreciation. Tax saved on depreciation. Let's just recap that approach again. Let's read the information about depreciation. It says that tax is 30% in arrears, and the depreciation is 25% reducing balance. Now, if it's in arrears and it's a 4 years project, then that means the timing of the tax is 2, 3, 4, 5. I'll do the same thing. I'll take the investment first. So we can just mention here what is our investment. The investment in this project is given here. It is $25 million. So $25 million is the investment. 3, 4, 5, 6. And we have got our scrap value, which said in this question here that the scrap value, assumed terminal value of the scrap value at the end of the 4th year, 5% of initial investment cost. So scrap value is 5% of initial investment. So I'll take the B27 and simply take 5% of it. So this is my investment and scrap value. Now, What we're going to do here is we'll take the investment, which is in B27, so B27 minus the B28. This will give me the total depreciation. Investment minus the scrap value. We've seen that. And then we'll simply take the tax on this one, which is 30%. And can someone tell me that what is this 7125? What is this 7125 value that I've got here? So can you please tell me what is the 7125000 value showing here? So we did that on the last question. So can you put your answers in the comments? What is this 7125000? Brilliant. Yeah, great. So right answers. This is the tax saved on depreciation. This is the total tax saved on total depreciation. How I wrote that on the previous working as well when we did the question here back. Total tax saved on total depreciation. So well done, well done. Total tax saved on total depreciation, yes. Now, we need to split this into all these years. We know that last year is balancing. Start from here. The investment is 25 million. So let's take the B27 into the depreciation, which is 25%, and then into the tax rate, which is 30%. So investment, B27 into 25% into 30%. We've got our depreciation tax saving in year 2. Then we'll take the last year, which is the B21, and I will simply take the 75% of this value, just as I did on the HIBAC question. Then I will take the B22 and take the 75% of that. And then my last year is balancing, so I will take the B25 and then remove the B21, B22, B23 from it. So this hardly took me few minutes, and I've got my right answers here in terms of the tax saving on depreciation. And in this exam, this was again 2 marks. So 2 marks on this working again. So I hope that you like this way of doing the tax saved on depreciation, because it's just quicker and less complicated rather than you working out the net book value and then the tax savings on that. So we've got 2 marks here on tax saving on depreciation. So far, we have now secured 5 marks. 1 for sales, 2 for variable cost, and 2 for tax saved on depreciation. Now, there was no working capital in this question, so 1 less thing to do, which means I can simply go into my NPV format now. So my NPV calculation now. So before I go into my NPV calculation, I'm happy to take some quick questions on things so far. The question here is, can you please tell why we started depreciation tax working from year 2? Because the tax timing in the question is in arrears. So in arrears means year 2, 3, 4, 5. So it's a 4-year project from year 1 to 4. Tax timing is from year 2 to 5. Okay. So 0, 1, 2, 3, 4, 5. I also need a column 5 here because of the timing of the tax in this question. So the first thing is to work out the operating profit, which I know is sales minus the variable cost minus the fixed cost. Now, remember, fixed cost was already inflated. I didn't need to do anything on them. So what I will do is, first of all, I do my sales minus variable cost. And I hope you all know that sales minus variable cost is contribution. So we can find our contribution line here. The contribution line is sales of year 1, which is in B10, minus variable cost of year 1, which is in B17. So B10 minus B17, B10 minus B17. And then just drag this forward and fill up the remaining years on the contribution line. So B1, B17. Once we've done that, we're going to put here our fixed costs, which are given in the question, which are 700,000, 735,000, 779,000, and 841,000. And at this point, I can find my operating profit. Operating profit, which is C32, C33. So that is my operating profit here for the first year, 10,168. And we can just drag this forward and fill up the remaining operating profit line, which comes out to be as the values here. Okay, so we've got our operating profit sorted for 4 years. The next thing is the T. Remember that mnemonic again, Otis. So O is done, T is tax. So the tax rate in this question is 30%, but remember that is in arrears, which means that there will be no tax in the first year, and the tax will be in the second year on the first year's operating profit. So in the first year's operating profit, tax will be in year 2. So we'll take this C34, minus C34 into 30%. So minus C34, 30%, which means that it will take this value, apply the 30%, and show it as a negative, which is an outflow. And then I'll just drag this forward, and it will fill in all the cells for me. So we've got our T, the tax. Yeah, we've got our tax. The tax in this question was 2 marks because there was calculation and also the idea that it has to be shown in the next years. Next thing is the tax saved on depreciation, which we have already done. So just need to bring these here. But remember, I have to bring these in the year numbers which are mentioned here. So this is B21. This is B22. This is B23. This is B24. So we've got here our tax saving done. Got here the tax saving. So that's the O, that's the T, that's the T, then initial investment. Our investment, which is here in B27, which remember is a negative, 25 million. For the scrap value, which is at the end of year 4, which is the B28, which is mentioned above. And this brings us to our Otis. There is no working capital, so I can simply have a free cash flow calculation. So sum from the B34 to B37. B34 to B38, sorry, B34 to B38. Let's drag this forward. I'll fill in my free cash flows. So these are all the free cash flows now done. Okay, so I've got all my free cash flows out now, and I'd be happy to take any questions from this point. So any questions at this point, if you may have, I'm happy to take them. I've got my free cash flows out, and before I discount them, I'm happy to taking any questions at this point. The question is, please revise working for savings. Repeat the free cash flow. Can we write net cash flow then free cash flows? Yes, you can write net cash flows and free cash flows. There is no problem in that. You can use the compounded formulas as well. I don't have any problem with that. Can repeat the free cash flow and the tax working. Okay, so free cash flow is the sum from operating profit to this point. From operating profit to this point. So we've got our free cash flows, which are O, T, T, I, S. There was no W, so free cash flows, which are ready for discounting. The tax working again. Tax was in arrears at 30%. Arrears means that there's a delay of 1 year. So we take the year 1 operating profit, but the tax on this will be paid in year 2. The operating profit of year 2, tax will be paid in year 3. Operating profit of year 3, tax in year 4. Operating profit 4, tax in year 5. So we simply say minus C34, which is this operating profit of year 1, and then into 30%. Just drag this forward so that it can fill in the remaining values. The saving working, I have already repeated that few times on the previous question as well. So once you'll rewatch the HIBAC question and this question, then I hope that that would be okay. Just quickly going over that. The years in which the tax saving occur, investment minus scrap value into the tax rate gives us the total tax saving on total depreciation. You split this into the number of years above. This year, last year will always be balancing. So we take the investment, depreciation rate, tax rate, and then take the last year's figures and then simply take the 75% of that for quick purposes. So once you rewatch the question HIBAC, we spent quite a lot of time on that, working on that question. So other free cash flows. Now, if you would like to put in the discount factors, then present values, and then the NPV, I don't have any problem with that, but I'm just going to use the NPV function here to be quick. So we'll take the NPV. The discount rate, remember, is 12% in the last line. Specify the range of free cash flows, which are from year 1 to 4. So that would be the C40 to G40. So C40 to G40, and then put the investment separately as an add, which is the B40, and then that's it. So NPV 12%. Free cash flows range from C40 to G40, which is this, from C40 to G40, all these free cash flows, and then close the bracket and put the investment separately. So once you'll do this one, get your NPV, it comes out to be 10,474. So 10,474 is the NPV here, and then that's it. So this will give us 1 mark, and that will complete our 9 marks on this question. So we're done with another NPV. I'm happy for final set of questions on this NPV before we move into the idea of discounted paybacks. Any final questions here on this NPV before we move into the discounted payback? Okay, that seems all okay. Before we go into discounted payback, let's go into a bit of notes taking on payback and discounted payback. So let's put here things. Payback first. It is time it takes to recover initial investment based on free cash flows. And again, free cash flows are the one which have been adjusted for everything, and we don't need to adjust anything more than that. Then discounted payback. It is the time it takes to recover initial investment based on present values. So the only difference here is that payback uses free cash flows, or the net cash flows if you like to say, and the discounted payback uses the present values. Now there's a structure we use. We say a year, free cash flows or present values, cumulative free cash flow or present value. And within this structure, we will solve the idea of payback and discounted payback. Okay, so this is the structure we're going to use to solve it. We'll see the numbers in some time. But before I go into the numbers, we just need to understand a bit of evaluation on payback and discounted payback, that what are good and bad things here. So I'm going to do this together. So advantages of payback and the discounted payback. The first advantage here is that the cash flows are used and not the accounting profits. So it is difficult to manipulate. Difficult to manipulate. Number 2, the understanding is easy for shareholders as it tells them when they receive their investment. So it's a simple measure for the shareholders to understand. Number 3, time value of money is considered in discounted payback, making it more realistic. And 4, it is easy to compute and does not require extensive finance skills. Very simple calculation. So a quick memory aid again for you to understand or remember the points here. And the memory aid here is cute. So C is that it is cash flow based. U is that understanding is easy for the shareholders. T is that the time value is considered in the discounted payback. So this point will only apply to the evaluation on discounted payback. And E is that it is easy to compute and does not require extensive finance skills. Now the disadvantages. Number 1, the forecasts may not happen as predicted, and actual payback or the discounted payback may be different. Because remember, all this is made on future forecasts, which may not be true. Number 2, it ignores the timing, or it ignores the time and cash flows after payback is complete. So we usually do not look at cash flows after the payback is accomplished, and these cash flows may be unviable. If that is the case, then your overall project profitability or the NPV will suffer. And number 3, target payback or the target discounted payback is required for meaningful analysis. We need a target payback to conclude if the calculated payback or the discount payback is good or not. And again, the memory aid here is fit. So on NPV, we say best prob as the memory aid for advantages and disadvantages. And on payback and discount payback, it is the cute fit, the advantages and disadvantages. So I hope that was useful for you to bring up some points in the exam and to remember it as well, that if this comes up, then how would you tackle it in the exam positions. Now, going back to this question, I'm going to go into part 2, which says calculate the discounted payback period for the planned investment project for 2 marks. So we have to think of discounted payback. Now remember, the discounted payback is calculated on present values. And I have got an NPV here on which I need the present values to find this discounted payback period of the planned investment project for 2 marks. So let's do this together. Let's try and do this discounted payback. So we can say here that in A2, we are planning to do the discounted payback period. So first of all, we need the present values. We need the present values here. So I'm going to create the column here. Free cash flows, discount factors at 12%, then our present values, and then our cumulative present values. So the discounted payback is based on cumulative present values, or T0, or just the 0, 1, 2, 3, 4, 5. So putting in the free cash flows from above, this was the B40. This is C40, D40, E40, F40, and G40. So we've got my free cash flows out from above. And once I've got my free cash flows, I need to put the discount factors at 12%. So let's use the formula sheet and put the discount factors at 12%. So 12% discount factors, 0.893. Then we've got 0.797, 0.712, 0.636, and 0.567. Once we've got my 12% discount factors out, from the present value, which is the free cash flow B47, into C47. So B47, C47. And now I'm going to drag this down to fill in the remaining present values, use a separator. Done. I've got the present values out now. Once we've got the present values, we now need to think about cumulative present value. Now the cumulative present value will start from here, the D47. And then I need to add the next year's present value onto this cumulative present value. So what I'll do here is I'll take the E47 and add the next year's present value, which is in D48. Then I will take this cumulative present value and add the next year's present value onto it. So we'll take the E48 and we'll add the D49 to it. Just using a separator to make the numbers more presentable. Now, I've got here negative 6 million, and would you all agree that if I add the next year's present value, then this initial investment will be recovered, which means the discounted payback period is in between years 2 and 3. The discounted payback period is in between years 2 and 3. But that is not enough. We need to find out that precise time when that discounted payback period has happened. Well, what we can do now is we can find that discounted payback period, and we can say, well, it is 2. So it is between 2 to 3 years. So it is after 2 years. So I need to then find out the precise time period. Now, how much of money do we need to get our initial investment recovered? Well, we need here 6686942. We need 6686942. And how much money do we have coming up in the next year in terms of present value? It is here, the 9029766, which is in D50. So dividing that with D50, and this will give me my discounted payback period. So 2 years plus a fraction. This fraction will tell the timing within that year when the initial investment is recovered. And what we need here is how much of investment we need to recover, 6686942 over the D50. And D50 here is the present value of the next year, which we have coming in as an inflow. So this is 2.74 years. This is 2.74 years. So it will take 2.74 years for us to recover this the initial investment. Now it said here in this question, with a maximum discounted payback period of 2 years. So the target was 2 years, but I do not need to comment anything here because the requirement didn't ask me. It said calculate the discounted payback period for 2 marks, and that I've done as 2.74. So any questions here on this 2.74? Any questions here on the 2.74? Do not spend too much time formatting your answers. This sort of an answer is very good. Presentation. The only thing that you may like to do, even on this one, if you really want to, is to maybe just bring that in the middle, and then that's it. So it's neatly presented. It doesn't look like a messy calculation. It looks like a neat calculation. Everything has separators, and it is in the middle. And then that's it. So any questions on discounted payback here before we go into the next parts on this question? Okay, the question here is, when do we need to multiply the fraction with 12 while calculating discounted payback? Well, we will multiply with 12 if you have to work this out in months. So if you had to work it out in 2 years and certain months, then multiply that fraction with 12 to work out those number of months. But in this question, that was not needed. The next question is, we would not calculate the months. Well, it didn't ask you to calculate months, but if you really want to calculate the months, you can do. You can simply multiply that bracket fraction with 12 and you will work out in months, but it wasn't needed in this question. The next question is how we'll get these lectures. So you will have recordings. So again, ACCA team will get in touch with you or will be able to share the links with you once the sessions are complete. So this is it on discounted payback period. Let's go into the next requirement and look at this. Okay, so very interesting requirement. Discuss the financial acceptability of the investment project for 3 marks. So I would like to take the remaining time here, about 10 to 12 minutes, showing you how to construct sentences, how to do the discussion. Now, one of the biggest worry of this examining team of financial management is that the candidates worldwide at times are not able to construct sentences and write their answers to non-number requirements well. Now, there can be around 15 to 20 marks available. And again, the examining team is well within their rights to change that proportion, but I'm just going with the past pattern. There are 15 to 20 marks available for non-number based discussion on the paper. And we have to be good with this discussion to ensure that we are able to get the marks. Please remember that no financial management requirement asks for listing things, stating things. The requirements are to explain, evaluate, analyze, discuss. So we need some substantial or sufficient writing here or typing in your CB exams to be able to get the maximum marks. So to discuss the financial acceptability, we have used 2 measures here. We have used NPV and we have used the discounted payback period. So for 3 marks, I need to write something here. Now, 3 marks means that I need 3 good points explained well to earn the 3 marks. So the first thing I will say is financial acceptability. Financial acceptability can be seen with the use of NPV and discounted payback measure for Pelta, the company. NPV was positive, which means that shareholders' wealth will rise. Therefore, Pelta can accept the project based on NPV analysis. That's it. 1 mark. Yeah, 1 mark, but constructing a proper sentence. Then remember here, the discounted payback period was 2 years. That means the target was 2 years. And how much was our payback? It was 2.74 years. That means discounted payback was more than the target set as 2 years, which means that shareholders will not be able to recover their investment within 2 years. Therefore, project will not be accepted based on discounted payback. But the question now is that which of these measures you would trust? Which one would you go with? Would you go with the NPV, which is saying accept, or the discounted payback, which is saying don't accept? Well, the answer to that is Pelta will opt for a decision based on NPV analysis, which is the most superior method available to construct financial viability of projects. And that's it. This is 3 marks here. So 3 marks for this discussion here that we have done. 3 marks for this discussion that we have done here. But it has to be in this manner. Things must be written well. There must be spacing between your brief points to earn the marks and then make it easier for the examining team to give you the marks here. So I hope that this was useful, the 3 marks again. Again, please do not try to rote learn the answers of the past exams or from the revision kits, because you can simply come up with logical points yourself. I mean, I wrote this answer in my own words, and as long as I am talking sensible finance, I'm going to secure all the marks, all the credit. And this will give me 3 marks. Now, I don't know what the examining team has answered to this, but can we really produce examining team's answers in exams? No, we cannot. Those answers are for the guidance only, but we have to find our own way of answering these questions. So I hope this little exercise is going to be very, very useful. And we'll look at the next requirement now. The final requirement here, which is critically discuss. Some critical discussion here. Yeah, critically discuss. Say why some things are not appropriate. Critically discuss the views of directors on Pelta's investment appraisal. Critically discuss the views of directors for 6 marks. Now, we'll just read this last paragraph again before we construct an answer to this. It said, the views of the directors of Pelta, which we are going to critically discuss, are that all investment projects must be evaluated over 4 years of operations. Well, why 4 years? Because they are thinking of a sales volume to continue after 4 years as well in this project. So why not consider it in the bigger time period? Why only 4 years? With an assumed terminal value of 5% of initial investment. Well, how did they come up with this 5% question? Then both NPV and discounted payback must be used. Well, fine, but isn't NPV far superior? So if NPV gives you a decision, then we can just ignore the discounted payback. With a maximum discount period of 2 years, well, who came up with this idea of 2 years? Well, these are some of the things on which we need to do a critical discussion. So it is not statement, it is not listing, it is discussion. So let's do this critical discussion on some of the points which I have put here, or we have just read now. So let's think of Pelta's directors' views. So the views of Pelta's directors are not complete and inaccurate in some assumptions they have made in this Analysis. For example, it must be questioned that why the directors want to evaluate the project just for 4 years when they expect the volume to continue after 4 years as well. A bigger time horizon would have resulted in different numbers. Which may have further improved the computations. Okay. Second point. Assumed terminal value at the end of 4th year of 5%. It needs to be seen how the directors have reached assumption of having 5% terminal value, and if this is too low or high, as it will impact the NPV computations above. Then, third point, both NPV and discount payback must be used. It is also a question that why the directors are insisting on using both NPV and discounted payback when NPV is a superior method and can be trusted as it directly links with the concept of shareholders' wealth. It can be seen above that NPV and discounted payback gave conflicting answers. NPV said accept, discounted payback said do not accept. Finally, it must be seen how the directors have computed the target of 2 years, as it may be a difficult target to achieve. Directors must have shareholders' consent in setting these targets. And that's it. Now, how many points I've discussed here? I've discussed 1, 2, 3, 4. I've discussed 4 points here, but 2 of these points were 2 marks each because I explained them really, really well. And this is what you need to think. If it's a 6 marks requirement, we need enough points here to secure the 6 marks. And this answer here is giving me 6 marks here. And I've got 4 points where 2 of the points were giving me 2 marks each. Now, again, my answer is different to the examining team's official answer. But this answer will also secure 6 marks because the points here are all valid. And I do not need everything in the world to get these 6 marks. I do not need to write everything that I know to get the 6 marks. And this is what I expect you to produce in exam conditions. This answer is not at a tutor's understanding levels. This is at a student's understanding level. So I hope that this was really, really useful. And now you can see that what sort of discussion that you need to do on this paper to earn the marks. Feel confident and positive about your points, and the only thing which examining team wants you to do is to explain them well, rather than simply saying in bullet points or brief points, express yourself, and you will be getting your maximum marks. Now, let me check if there are questions. Any questions here are coming in? Okay, so those who are finding it very useful, thanks for your kind comments. The good thing is that you can always watch the recordings later, so to refresh these knowledge gained here. The question is it enough to practice all past paper questions for pass? Well, the financial management exam is a paper where you will have past questions available, I think, from 2013 maybe. If you can do as many questions since 2013, the ones available on ACCA's website, I think that is what you need. If you can't do all the questions, you do the right ones, and the questions which I have identified on this webinar are definitely the ones to focus on. The 5 questions, they cover quite many areas. There's a question saying, how do you ensure you do well in discursive bits? I always find them difficult. Well, just as I explained them now. So keep the points simple. Do not complicate your points. Keep them simple and just simply explain them well. There is another question. Explain ARR, please. I can just maybe quickly go over ARR. Let me just quickly go over ARR. We just have a few more minutes, so I can just quickly go over ARR. So the accounting rate of return. Accounting rate of return, and we also say sometimes that is ROCE. This is a decision-making tool. Number one, there's not a ratio. So there's a calculation involved here, which is the average annual profit over average investment. So average annual profit over average investment. Now we need to see how to compute these. The average annual profit is total operating profit minus total depreciation over the number of years of project. That will give us total average annual profit. An average investment is your investment plus the scrap value dividing it with 2. That gives us the average investment. And once you've got all this, then into 100, you'll get a ROC or accounting rate of return, which just tells us that based on the investment that we have employed, what is the return that we are getting. And then you should have a target ROCE to establish if it is good or bad. More questions? Okay, so that is all useful. Just very quick, last bit thing. Just one last thing here. Just one last thing here. I would just like to show you the IRR function as well, just in case you would like to use it in the exam and if it comes up in section C. I would just like to show you the IRR function, and then we'll close. So here is my free cash flow on this NPV. And if you had to use the IRR function, then you simply say equal to IRR. And in the brackets, specify the range of all the free cash flows, which are from B40 to G40. B40 to G40. So these are all the free cash flows here, including the T0. So 0, 1, 2, 3, 4, 5. And this will give us your IRR, which in this case, in a percentage, is 30%. So quite a high IRR. And that's it. So if it is a section C question on IRR, please feel free to use the function as it gives us the accurate IRR. Or if it is a section A or B question, then you can use the IRR formula, which you know, to calculate the IRR. So this is how we use the IRR function. And then you will be commenting on your IRR. A few more questions. Sir, but in exam, IRR and NPV are not work in. No, they work perfectly fine. They work perfectly fine. So we are doing right now a question on the ACCA's CB portal. So anything that works fine here is working in the exam as well. Okay, any final questions? We just have maybe last few seconds on this first session of the webinar. Okay, so what I want you to do later, tonight or tomorrow, is that you can look at a question millennium, which is focusing on EAC and lease versus buy decisions. We did not have time to go over that, but the question is really good. VIP question from the specimen exam, another one focusing on NPV, and finally the HDW question, which is also focusing on NPV, which is in the extra constructed response questions. So that is good question practice considering these questions. And on session 2, which will be in 2 days time, so that is on the 13th of Feb, on session 2, we will be going into business finance. So any questions on that, or just your preparation for next 2 days, and then we will go into the questions on the business finance bits when we do the session 2 in 2 days time. So I hope that this first session on investment appraisal was very, very useful, and I hope that you enjoyed the webinar today. Good luck with your preparations. So enjoy your studies, and then I will see you for session 2, which is in 2 days time. Thank you very much.